coming to alpha, for years investors have always chased alpha, but in this age of information abundance, the rise of passive investing, and markets that grow more efficient by the day, a difficult question hangs in the air. Does alpha still exist at all, or has it become simply harder to find? And here to wrestle with that question is one of India's most recognized business journalists, Sonia Shenoy. And joining her on this panel is Vikas Khemani, founder and chief investment officer, Carnelian Asset Management and Advisors. Devina Mehra, founder, chairperson, and managing director, First Global. And Kalpen Parekh, managing director and chief executive officer, DSP Asset Managers. And of course, Prateek Agarwal, managing director and chief executive officer, Motilal Oswal Asset Management Company. Ladies and gentlemen, please welcome our panel.
Good morning, everyone, and thank you so much for being here. It's such a lovely audience. It's a huge audience, so that's always good. And to all of you, thank you. I think in the last 2 months or 3 months, I've met each one of them multiple times, and we've spoken on multiple panels, and all we do is wonder where the market is going. I don't think anyone has a concrete answer to that. In fact, yesterday I was sitting with Kalpen at another panel, and all we were doing is asking each other, do you know? Do you know? No, you don't. So I don't know what the outcome of this is going to be, but we're going to try and find out whether alpha is dead or it's still alive. Devina, as always, ladies first. Do you think alpha is dead in the Indian markets now? Or do you think that, given everything, generally they say like there's a signal to noise ratio and there's a lot of noise in the market right now. So if you had to give us the big signal that you're looking at, what would it be?
I think nobody knows exactly where the bottom is. But of course, my advice has been that A, never have 100% in equity, and B, most of the time, whatever is your equity allocation, remain invested in it, because equity should be money you don't need for 7 to 8 years. So this is the whole problem that, in theory, if I ask everybody, they will say, yes, the most volatile asset class in the world is equity. But when you're living through the volatility, it seems it is something unprecedented, and, how will this ever end? That's how it appears. Yeah, in terms of alpha, they're always, in normal markets, at least about 40% of the stocks outperform, that's the data. Last year was very unusual. It was a very narrow market. So at one point, there were only about 12 or 15% of the stocks outperforming, which is why for 2025, even though the indices were up, the average stock was down, and 40% of the stocks were down more than 10%, which is why the pain in the portfolios was not quite captured by the indexes. Now the market is broader, so that's one positive, that again you see many more stocks outperforming. In general, I would say don't believe anybody who tells you they have the magic formula for multi-baggers. So always spread your bets, always diversify. And I'll give you a very simple example as to, diversification is not magic that 50 stocks is better than 15 stocks. All diversification does is that in a game of luck and skill, and investing, like most things in life, is a combination of luck and skill, increases the proportion of skill and reduces the proportion of luck. That's all diversification does. Like if you toss a coin, if you toss it 10 times, you might get 7 heads or even 9 heads. But if you toss it 100 times, you are likely to be close to 50-50. So if your stock picking skill is that you are right maybe 60% of the time, 65% of the time, which is actually a very good ratio, then in actual results, you will get something like that. So do the boring stuff right and don't try to optimize. So that would be my first advice. So get the asset allocation, go beyond India also, not just in multiple assets, which I'll be talking about in the afternoon. But that would be my broad recommendation.
Okay, so I also want to talk to you about that, because you've been advocating global investing for very, very long, and now there is so much FOMO around global investing. But since you spoke about direct stocks versus...
Yeah, I went global in 1999. Nobody had dreamt of it then.
A fair point. And now there's a scramble, right, to get to global investing. But I mean, it's perhaps justified given the way most global markets have moved. But let's try and get a show of hands here. Since you spoke about direct stocks, and we have here mutual fund managers, we have PMS managers, we have global investors. So let me get a show of hands. How many of you in the audience do direct stock investing? Okay. And how many of you have lost money? Vikas is saying everybody has lost money. Not too many actually, not bad. And how many are mutual fund investors only? Just mutual funds? Wow, there's like hardly any.
Lot of potential. Yeah.
Kalpen, what is going on? There's hardly any mutual fund investors. So mutual fund and stocks.
Only because, I mean, see, the thing is, everybody thinks that they are better than average. You know, if you ask in driving also, I think 80% of the people will say I'm above average driver, which is statistically impossible. So everybody thinks they can do it.
Okay, fair enough. Yeah, that's true actually. That is true. Kalpen, so, you know, I'm sure for mutual, and we had this discussion yesterday, right? SIP investors, it's been a struggle last 2.5 years. And you said that one needs to be equanimous because that's the only way to battle this volatility. But talking about alpha, which is the main overarching theme, how do I generate alpha at such a time when not only is India underperforming, but India has a long list of problems to deal with?
So first of all, you can earn alpha. You need few conditions for that. One is you should be skilled as an investor. Two, whoever you give money to should be skilled. Third, you should be lucky. And fourth, even that person should be lucky. You need a combination of all these. And most importantly, see, I think the starting point I would say is that we don't deserve alpha. It's a baseline. Because we generally don't know what generates alpha. Before asking the question that alpha exists or not, the question to be asked is what generates alpha, number one. The second question to know, or the important information to know, is that alpha is not linear. Alpha is volatile. And higher the alpha, higher the volatility of that alpha. So we all very loosely quote Warren Buffett, right? All through. We all have his books on our shelf, mostly unread.
Especially in bear markets.
And mostly unopened. Over 65 years, he has a 8% alpha over the S&P 500. But over last 20 years, he has no alpha. And he can afford to, operate the way he wants because he says, I have ideology. I don't invest for alpha. I invest for an ideology. This is the way I want to invest my money. Now, point I'm making is that most of us, so if you know the truth that alpha fluctuates and then if you're going to invest in an asset class or a fund after an alpha cycle has happened, effectively you're buying at the beginning of the end of alpha. So at least one thing that I learned after like 12 years of being in this industry, it took 12 years to know this one-line truth, that if you want to earn future alpha, search for good fund managers or funds who currently do not have alpha in a way. So you need to identify who has class, which is generally permanent, and who's currently out of form. Because there will be things, so guys who have class are not very fluid. They do stand for few things. And of course, I'm not saying you should have dogmatic, rigid investment principles which do not evolve. But you stand for few things. And there are money managers who stand for few things. When market doesn't align to that, they will not have alpha. And the debates on alpha are also lacking of objective data. So I'll give you again a real life example. 4 years back, 3 years back, all headlines said that, in large caps you cannot have alpha because large caps are well discovered. In small and mid cap you can have alpha. Now just look at data for the last 2-3 years. 70-80% funds in the large cap universe have created alpha. 85-90% funds in the mid cap universe have no alpha because the index is designed in such a way in mid cap that everything is rising. And the mid cap, and you ask people how many of you have lost money, made money. As of yesterday or day before yesterday, most mid cap funds have hit their all-time high.
Yes.
So where is the bear market?
The index also, the Nifty Mid Cap 100
index also and funds. So where is the bear market we are worried about? So you should worry about कि अगर इतना worry अगर 5% negative return से आ रहा है, bear market is like 5 years of zero returns.
But I think the problem here is not that. The problem is, see, when you have a house which is like a 4 BHK, but if your neighbor has a 6 BHK house,
envy.
Then you're worried, right?
Yeah.
So when India is doing
No, so I'll answer that.
Taiwan, Korea,
So,
US, China are all doing 4x.
That's the point. The point is the time to talk about China, Korea, Taiwan, Europe, US is exactly when India is doing very well. If you know the fundamental truth that everything fluctuates, including our life, including our breath, including nature, everything fluctuates and mean reverts. So when we are at peak alpha in 2024, every conversation that gets celebration and claps is about all others are idiots and we are gods. That was the time to think of international investing. Now today when India is not doing well and others are doing very well, now people are chasing, all those other markets. So again, the point I'm making, Sonia, see, ultimately we have to solve this debate or conclusively give an answer. And the conclusive answer is alpha is mean reverting. If you want to search for future alpha, search for where is alpha not there today and are there likely drivers, and spread your bet, like what she keeps talking time and again. You have to increase the surface area for, and see, I think as investors, we should not take sides of an asset class or a country or a geography or a style. Why are we taking sides without knowing, we don't even have 5% knowledge of our domain. Yet everyone wants to be most opinionated without objective data. And I think why we do not deserve alpha is because we don't have basic data, basic homework to know what generates alpha and what are the levers of volatility of alpha. So the fundamental point is, in the long term, asset classes fluctuate. If you buy them at reasonable or fair valuation, generally you will make more money. If you buy them at obscene valuations, the guy who's selling to you will make more money, not you. So I think this is an important point to keep in mind.
Just to add to what Kalpen said, he talked about mutual funds performing for or whatever kind of fund performing. I'll just give you this statistic. I mean, again, one book which many people will have on their shelves at least is Peter Lynch's One Up on Wall Street. Now, the fund that he managed for Fidelity was, I think, the best performing mutual fund of all time in the US. It compounded something like 28, 29%. But the average investor in the fund compounded only 7%, and a good percentage of them lost money. Lost money in the best performing mutual fund in history because they entered and exited at the wrong time. Because typically they entered after a big outperformance, and then the next year there was a huge underperformance and they exited. Okay. So this is like a one-line post I have posted multiple times on social media, that one truth in markets, that themes change. Asset classes, countries, even investment styles go in and out of fashion. So
Got it. No, fair enough. 100% agree with you. Vikas Khemani, when we spoke during Diwali, I remember, there was a panel of 4 people and 3 out of 4 were still bullish on the market, let's be honest, right, in October. And since then, the market has fallen further from there. Maybe not mid and small caps as much, but large caps, underperformance, all of that. But now, is this a great place to be? Do you think that perhaps we are somewhere near the bottom? And is this a good time to generate alpha? And if yes, how?
Hi, Sonia. I wish I knew that all of us knew during Diwali time that Trump is going to do what he's going to do. So otherwise we would have given you a bearish view. So these kind of events would happen. I think investing is all about long-term game, and you cannot predict what's going to happen. You're just going to do bottom-up stock picking and long-term investing. That is, to me, my mind, is the real investing and staying invested. The question you are asking is alpha dead, or in my opinion, alpha will never be dead. Alpha is what? Generating superior risk-adjusted return over whatever your benchmark is, right? That is alpha, right? Now, that alpha should be there in every market. It depends on your investing style. It depends on your, are you able to generate that or not? In my opinion, India is a great place to generate alpha. Not only now, but over next, 10, 15 years. More importantly, especially, alpha becomes whenever an economy is transforming, that's a great place to generate alpha. For example, Devina just mentioned that Peter Lynch was one of the best fund manager. He generated 14% alpha for a good 15 years period, 28, 29% return, beating the benchmark 15% return, right? That time, US economy was transforming. US economy was in a pretty much similar stage where India was. That US economy was going into a phase where, you went, I think, about from $2 to $2.5 trillion to $5-6 trillion. New sectors came about. So I think India is also in that transformation phase. And that is what is, in index, today, let's say, for example, manufacturing is a great opportunity. How much manufacturing is represented in index? 1992, when India, did reform, 2 big sectors after that reform came out was banking and technology. Both were significantly underrepresented in index for a very long time. Axis Bank, I remember, became part of index after it became 85x. Infosys became part of index, I think, after it became 50x. So I'm saying the real opportunity, lies whenever economy is transforming to look at the sector segment which are not representing it, and that is where the real source of alpha. Second source of alpha, which I think according to me, and especially which is very, very relevant in times like this. There was a time when, information edge was a very big edge. If I got information ahead of you, I have, able to get that advantage. And lots of people in this country, in many countries, have made big money out of that, generated alpha out of that. That is gone with the, disclosures and, social media and everything today. What information I get, I think millions of people get at the same
And with
time.
AI also.
With AI and all those things. So information edge is out. Intelligence also edge is going down, in the sense analytical edge, as they were earlier, because the AI and all those things, that's also going down. So what remains, in my opinion, significant advantage for anybody is two. One is the experience edge, that how much you understand, how much knowledge you have of the sector, company, or markets in that sense. And secondly, most importantly, is the behavioral edge, right? That is where, according to me, most people fail. Again, to go back to the example Devina said, that most investors made lower return of 7-8% and lost money in a best performing fund. So even in the best performing market, you can end up losing money because of your own behavior, your own ability to handle volatility, your own ability to not understand how money is to be made. So according to me at least, so what I call perspective edge, experience edge, behavioral edge, that is the edge which will determine alpha, not today. And especially this edge has become far more relevant when everybody has become short term. Every information is like available to same at a fraction of a second. We see swings happening, euphoria to fear psychosis. Example, you talked about today, what is the talk of town? We must invest globally, diversify globally. This is the most easiest thing to talk about. Let us now talk about it. People don't look at data. September 24 ke baad mein AI trade picked up really meaningfully. If I were to take this 1.5 years period out, India is the best performing emerging market ahead of Korea, Taiwan. Pick up anything over a 5-year, 10-year, 20-year, 25-year period in dollar terms. Korea, before September 24, had a 3-year negative return of 8% per annum. So if you take last 1.5 years period out, everybody looks pale. It is very easy to sell with the recency bias, saying Korea has done well, Taiwan has done well, hence we should diversify. The real skill was, if somebody had ability to pick up that AI trade or semiconductor trade will pick up, that time they should have invested. It's like after gold has done, a lot of gold funds will come out. Today lots of global funds are coming out because it's easy to sell. Behaviorally it is easy to get investors, trap investor, whatever word you want to use it.
No, I take your point about recency bias, and that point is 100% taken. But I think the argument about global investing is because the data is there for everyone to see, right? If you talk about manufacturing, for example, manufacturing as a percentage of GDP in India has been the same for the last 20 years, right? Look at Vietnam. I'm not even talking about China.
I am saying look at the returns. 20-year, 25-year return, any period of return.
But that's backward-looking returns, right?
But I'm saying, what else you look for? I'm saying if you look at 5-year, 10-year, 20-year, 25-year return of India, in fact, since 2001 also look at, to any period look at, India has done very well. In dollar terms, as much as we get beaten down by our rupee depreciation, in dollar terms, like if I say again, just take 1.5 years return. India has been in a difficult spot for the last 1.5 years. It's been 11% 20-year return in dollar terms. No emerging market. US 20-year return in dollar terms is 10.9%. So India has been it's delivered. Now it was very nice to romanticize again and again because 1.5 saal mein return nahi aaya hai. So that is what I'm saying, in my opinion. In this period, your conviction that was India will deliver. This is the time when you can find every fault with India and every positive about other markets because the return is speaking. But this is the time to use your experience that everything is not wrong with India and this will not remain so forever.
But do you agree that India, in many areas that we've spoken about, AI, robotics, ML, deep tech, semiconductors, has fallen way behind? So going ahead in the next 5 years, do you agree that there is some degree of growth laggard also that India is going to face compared to the rest of the globe?
No.
So why should foreign investors then put their money
here? That's again the wrong
here?
thing. Tell me one economy which is going to grow at 6.5-7%. Forget. See, ऐसा कहीं लिखा तो नहीं. Of course, you want to be innovative economy, no doubt about it. But which economy is growing at 6.5-7% foreseeable for next 10 years? Tell me one economy. None. So you are the fastest growing market. I can tell you 10 drivers of the growth for India, which does not exist in many other markets. If I were to tell you today the statistics of US in terms of leverage, in terms of, lots of things which we all talk about, you will be scared. I mean, it's not a triple A country. But point is that today 70% of the market cap is global market. Today on all parameters, it is away from dot-com bubble, GFC bubble. On all parameters, whether it's corporate debt, household debt, zombie companies, market leverage, and the all kind of IPOs are coming. So I'm not saying that US will sustain. I'm just saying that today it is very easy to get convinced about the global markets looking at India in last 1.5 years. That's not the right way to look at.
Okay.
Your diversification should serve a purpose, not recency bias. Just look at most people invested into gold after gold rallied, not before that.
That I completely agree, and you're quite convincing. But let me ask Kalpen. Yes, come on, like help me out here.
I wanted to.
Devina.
I just wanted to add something to. See, I mean, you can pick an end point and show anything. Let me tell you, from 2010-11 onwards, for a whole decade, India in rupee terms compounded only 8.8%, which was more or less fixed deposit returns. In dollar terms, it hardly gave any returns. I think it was a 1% compounding or something. So, so global, I totally agree that you should not look at what has performed of late and jump there. In fact, we actually did an exercise that if you systematically invest in what has done well in the past 1 year, you will equally systematically underperform. It is the worst way you can do it. Manufacturing, though, Sonia, as a percentage of GDP, is at all-time low. Manufacturing in India as a percentage of GDP is where it was in the 1960s. It is in the 13% range. It was 17 and a half from about 2009 onwards. For 5-6 years it was in that range, and it has just been falling since then. I mean, that's an aside, because markets and industrial data are two different things, but that is really the data.
So, okay, Prateek, I want you to come in also on this. First on the manufacturing part, because it's not like how the situation was 10 years ago, right? 10 years ago, we didn't have so many new players, large exporters, etc. Now the world market has become so competitive.
I want to speak on alpha first.
Sure.
And make it very simple. So, point one, everybody has to have a belief
Take the mic a little
as
closer.
to why stock prices move up. Why do stock prices move up? Everybody would come down to one number, which is growth. Not one period, multi-period, right? So like Vikas said, when you are in a period of disruption, you get that new space where growth can be meaningfully higher than index for multiple years. Simple. See, there are periods in the market. 2008 to 2020, index grew faster than any other part of the market. The percentage of people generating alpha was 15%. I mean, I count the number of funds, so that's the number in my head. In this period, when if you see broader market earnings growth has been better than the narrow market, the percentage of people generating alpha has been much better. This is the period for alpha because the change that we are witnessing over last 3 years is of a velocity that frankly I have not seen. So earlier we used to go to shop, for example, for buying stuff. Now we do it online. Most people in this hall would be in an ICE vehicle, but the next vehicle most people will buy is going to be an EV. Okay, ICE is in the index. That business is going to be valued 0 in some time. EV is not there. And you can go on and on. Capital markets, defense, EMS, he spoke of electronics. So newer spaces, just like software happened in 90s, just like new private sector banks happened in 2000s, small but a long runway of growth. Now, long runway is important for another reason. Most people will say valuations. if the runway is long of a meaningfully higher growth versus the index you are competing against, chances of you having excess returns increase. Don't go for 1 quarter, 2 quarter, 1 year, 2 year growth. वो तो price में है. Longer period growth. So as soon as you flesh that out and you stay the course, magic gets created. I agree with what Kalpen said. It is volatile. So if you see all of my public communication, we say we will be consistently inconsistent. So that is the only thing that works. Especially if index is made up of companies which had a glorious past. They suffer from legacy issues, so which was not true from 8 to 20. Now, how fast can somebody innovate? How fast can the biggest auto company in the country which sells only ICE become EV? They will cannibalize themselves first. How fast will... So, in a period of change, if you spot the changes, look at the kids, what they are doing, that's a great way of spotting the change. Back them, chances of generating alpha is higher. This is the period for alpha. Look at last 3 years, 4 years, look at percentage of managers generating alpha versus 8 to 20, you would find a high increase.
Okay. So this is the period for alpha. That's what Prateek is saying. Kalpen, yes, you wanted to make a point.
Two things. At least data shows that GDP growth rate does not necessarily mean great stock market returns. China is an example of that. The fastest growing country on earth. And for 25 years, the stock market gave zero returns. So capital efficiency of growth becomes important, and what price do you pay is equally important. Number two, I agree with what Vikas said, that there is huge recency bias in the last 3 years for global stocks. But let's also acknowledge that 3 years back, there was huge recency bias for India as well. And we easily take our recency bias as acceptable, but others' recency bias as unacceptable. And the third point I want to say is that any data point that I see in investing, whatever I may say, all four of us may say, and assume all of it is different to each other, is proven right in short periods of time. The other condition to ask always or add is, on large sets of data for long periods of time, few principles last. But in short periods, everything can be proven right or wrong. So I may say that passive works. In certain periods, passive will work. I may say that only active works. In certain period, only active may work. I may say that global investing works. In the last 5-year data, global works. Data can prove that. And I may say that no, global doesn't work, India works in some patches, but over very long periods of time, if you have to see this, and that's what, if I were the audience, the point I will think is, मैं करूँ क्या इस सब का? What do I do about it? And the point I want to tell all of you, from all of us also, is first look at data and odds and look at rolling returns always. Do not look at point-in-time returns. So today, it's easy to make a case for global investing because point-in-time return is in favor of global investing. 4 years back, enough people have said, why should you ever do global investing? Because either ही alpha है, वो भी गलत है. And now I'll give you one data point to ensure that, data-driven conversations take over narrative conversations. I have data since 2005 because my tool has data since 2005.
Are you using ChatGPT?
No, right now I'm not. It's actual data because there's a lot of error in that many times. So 2005 till today, 22-year period where everything that can go right for India and wrong for India has happened. Everything that went right for China and went wrong for US, all of that, gold, I've captured everything. So I've taken 5 asset classes: Nifty 500, S&P, which is US, MSCI, which includes S&P plus the rest of the world, then China and gold. And if you're done 20% each to all 5, dumbly, without any intelligence. And invested for a 5-year period, rolling 5-year period, so that all ups and downs are captured. The median return for Nifty 500 is 13.7. The median return for S&P 500 is 17.8 because in these 2 decades, S&P 500, and these are all in rupee terms. I've converted all the dollars into rupee. The median return for gold is slightly lesser than equity, 13.7 versus 13.4. Now, I'll compare to only Indian, and now if you mix all 5 together and rebalance annually every 5 years, 5 साल रखो और 5 साल के बाद some asset class instead of 20 would have become 25 because of appreciation, something else would have become 15, bring them back to 20. The rolling return of Nifty 500 is 13.7 median. The rolling return of the combined portfolio is 13.4. it underperforms by 30 basis point, but the standard deviation of Nifty 500, which is 5.39, the mixed portfolio standard deviation drops by half. Now, why is standard deviation of return important? For like Prateek mentioned, that standard deviation doesn't matter for people who are okay with volatility. But most of us, you have to ask this question, that if in 1 year alpha is not there and you're going to get edgy, then standard deviation matters to you. Then you need to asset allocate. Then you need to mix portfolios. Individual portfolios, high conviction portfolios are only for people who can stick with that asset class when it doesn't do well. Conviction means not when it does well. When everything does well, showing conviction has no meaning. But when something doesn't do well, you should not be worried and asking question that, India ka kya hoga, ek saal mein agar return nahi aaya to. And again, last point I want to say is that when you're doing equity investing, and this is something I learned over time, that don't seek, first, whatever asset class you're choosing, see when does it not do well. For how long does it not do well? So, I've trained my mind now to see, I want to invest in China. Let me see longest period of zero returns. Now, let's say if that data is 12 years. Am I okay with that? If not, I should not be investing in that market. If I'm looking at India, 93 to 2003, zero returns. Because you invested in a bubble. Very interesting data point. 2008 January, if you had invested in Nifty 50, which is when the bullest of bull stories of India was going on, or BRICS was going on, Jan 2008 till today, 18 years have passed. The return of Nifty is 9%. The return of Government of India bond is 8.5%. But you had waited 8 months more. And there was panic after 8 months because GFC happened, 50% collapse happened. You invested in September 2008. Till today, the return is 17% CAGR.
But that you can't catch the bottom.
No,
also.
it's a great point you made. If you can't catch the bottom, we acknowledge that. But then why do we chase the peak? Because we invest most money at the peak.
Yeah.
The largest flows in that cycle in India came in January 2008.
Okay, I have only 10 minutes left and I want to open the floor for questions. So please keep your questions ready. We're going to take some really interesting, we already have hands up there. But before that, a quick point from your end. He said that 1993 to 2003 was a period where we saw absolutely no returns. And actually it caused a lot of trauma for a lot of people because every panel discussion, people remember that 1 decade of no returns. So you think we are in a situation like that where it could be a very long drawn, painful, no return kind of situation for India?
I don't think at all. Again, like I said, it's very easy to draw that conclusion after seeing 1.5 years of no return. While GDP growth does not mean that it will return, but corporate profits growth does always represent the market cap growth. India's corporate profits have grown between 14 to 15% over last 10 years, over last 25 years, right? And I think that trajectory is very much on from a corporate growth perspective. There will be periods. Today, see, in 2001, total corporate profits of India was $8 billion. Last year, it was $180 billion in 25 years, right? I think in 10 years, that number can easily, can go between $800 billion to $1 trillion. Now, if you believe that, then you can easily make a case that if it is $800 billion to $1 trillion, your market cap will be anywhere between, take whatever, 20p and, 16 to 20 trillion dollar. We are at $4-5 trillion. So I think corporate earning growth is something I have quite, conviction in. Secondly, India is one of the very few markets where the ROEs are very good, 15-16% ROE. So return on capital is very good. Very few other markets. China does not have ROE. India has, US has, and that's what, So I think that I don't see changing anytime in a hurry. It at least looks in the right direction. All other structures are macroeconomics. Right now they are looking a little challenged because of the currency, which I'm sure is not permanent. But I think directionally, I think we are not in a 10-year no return kind of market. There will be periods when there will be no return. There will be periods when there will be excessive returns. There could be period when we have 40% return in a year. But that's part of the normalization cycle, in my opinion. That's my deep conviction.
Okay.
In fact,
So
the
just
sequel
one
to
point.
the 2003, the 9-year period without return was that in the next 4.5 years, the index went up 6 times.
Yeah.
So, that is what is meant by equities are volatile. It is not that 1 year you will get 25% return and the next year you will get 12% return. The next year you might get minus 30% also. Yeah. That is what is meant by equity being volatile. And also remember the Nasdaq high of 2000 was not taken out for 15 long years. It took 15 years to recover to that Nasdaq index. We think the whole world has always been driven by the US market. So, always look at data and don't drive looking in the facing backwards.
Yeah. Okay, I'm going to come to you guys. I want to take some questions before we end, and many hands up there. Okay, let's take the one lady right here in the front first. If someone can just hand over a mic to her.
Thank you. My name is Deepika Kapadia. I'm an early Amazon employee and, just learning to invest for myself. My question to this esteemed panel is, if you strip away the emotion of investing in India versus outside of India, if you strip away FOMO also, because it's bad to chase something that's already at the peak, can we look at first principles and talk about, for today's world where there is a tech revolution, where there is perhaps some lack of disruption in the Indian corporate world, but still it's a glorious economy with a lot of promise. If you just looked at first principles, step back, how does one invest today versus just emulating what we've done in the past?
Okay, I mean, first of all, if you look at first principles, India is less than 3% of world market cap. There is no objective, rational reason why 90 or 100% of your investment should be there. I mean that, and plus the other fact is that you're already exposed to the Indian economy. You are already have your job here, your whole life here. So if anything goes wrong, you're already exposed. So I mean, logically, you should be invested a lot more globally. But at the very least, over a period of time, get 30-40% global. And this is not something I've been saying in the last 6 months. I've been saying exactly the same thing for years. As I said, I realized it in 1998. I went global in 1999. After the Asian crisis, ये समझ में आ गया कि being in a single country can be very risky. So that's if you first principles, that is the thing. It might sound very radical, but if you look at first principles, your majority of investment should be overseas.
No, I have a slightly different take on that. Hold once again, where do you get sustained earnings growth in the space that you are invested? Right, that increases the chance of your success. Otherwise, so जैसे आप line change करते हो, that will be the outcome. India is the economy, and this panel will agree, where growth will sustain for the longest period at rates higher than most of the other where 90+% of the market cap resides, right? So be in India for what India does best, and you have that tailwind of long period earnings growth. Be in the world for what the world does best. If in India we don't do AI very well, and AI is there in the US, and the memories are there in Korea, and chips are there in few countries, be there for that. Don't be there to buy cement and steel and all of that. All of that we do very well. So
Fair point. Okay. Let's take some more questions before we run out of time. Yes, the gentleman there at the back.
So hi, I'm Ayush Agarwal from Power Exchange India Limited. So just a small question. So we have been talking about asset allocation, and we have touched upon Indian equity, global equity, and gold. I want to ask a question, one missed out component of asset allocation, about the debt markets. So there are many fund houses here on the panel. So what is the debt market outlook, especially when in the last 1 year, liquid funds and overnight funds have outperformed even corporate bond funds? So what percentage allocation can be in debt, and what is the debt market outlook?
That's a great question. Kalpen, you want to take that?
See, again, you need to ask what is the driver of return for bonds. Bonds are currently trading at around 7%. So what you learn if you do nothing, or if bonds do nothing, is 7%. And if interest rates were to fall, you'll get something more as mark to market. If they were to rise, it will take away some of the carry. So if rates rise by another 1%, you will earn 7 minus roughly another 3-4% capital loss, 3-4% returns. If rates were to fall, you will earn 10 to 11% return. But broadly, on a medium to long term period, see, look at it this way. I think our view is that rates will remain where we are right now. Keeping in mind all pressures on currency, demand supply, amount of money to be borrowed, likely impact on fiscal deficit because of oil prices rising, some amount of support government might need to give to the economy if the Middle East situation continues to go longer. Odds of rates going down in a hurry are low. So assume 6 to 8% range probably that you could earn in fixed income. To compare debt returns to any other asset class on a 1-year basis is meaningless, because in the long term, in over a 30-year period, again you take rolling returns, bonds have earned around 7% return, stocks have earned 4 to 5% more than bonds. That's the big long-term picture that you should keep in mind. And the period of zero returns for a decade in stocks happens when starting valuations are 35, 40 times. Today our starting valuations are 18 times or 17 times. So equity is not a matter of worry. It's not a matter of celebration. It's somewhere in the middle. We also should remain in the middle. And in fixed income, rates will be somewhere here. So what is the yield of the asset is what most likely you will earn, unless interest rates move very sharply.
Okay, fair point. Any more questions? Yes, let's take the gentleman here in the first table. Yeah.
My name is Rishikesh Patil. I'm an SAP consultant. Previously, I worked with Accenture and IBM, and of late, I've started doing an independent work for international clients. And September 2019 onwards, I started doing a direct equity. So my question is that for generating an alpha, we look for a beaten down sector, or whenever the stock is at the bottom, we have to enter it. But to identify those bottom, or to identify those beaten down sector, what are your non-negotiable filters you apply it out? So to identify it out.
Okay, Vikas, you want to take that? Because Vikas, of course, he runs his PMS as well.
I think, first of all, I don't agree with that to generate alpha, you need to buy beaten down sector. All you need to buy is, as Prateek was also saying earlier, is that buy growth which is better than the broader growth, and don't pay the price. So essentially, all you are looking for is you capturing earning growth, and either you should get the valuation re-rating. If you don't get the re-rating, at least don't get the D-rating. For example, if you see last 5-7 years, ICICI Bank versus HDFC Bank, both have grown, but HDFC Bank stock returns have been 0, but ICICI Bank stock returns have been 4-5x. So what has happened in case of ICICI Bank? Corporate earning grew, but the one-time book has become 2.5 times book. That is the source of alpha. But in case of HDFC Bank, corporate profits grew, but the 4-time price to book ratio has become 2-time price to book. So while corporate earnings grew, so essentially what you're supposed to constantly grapple is between, what will generate. So generally speaking, at least I believe that large part of the alpha gets created when do two things: capture earnings growth and re-rating story, and avoid what are the return puller down. There's very often, common consensus, like everybody says, the quality stocks which gets overpriced, and they become the source of return draggers. Everybody believes that's quality, and hence everybody invests that, but you don't say what price to be paid for that. So price you pay is also a very important part of the return generation. So to generate alpha, you have to have a different perspective than rest of the market to generate. If you have the same perspective than rest of the market, then you will get the same outcome as the rest of the market. So hence, what is yours edge, what is your knowledge, what is your perspective than rest of the market is something you have to constantly argue in your mind, debate, and then say, can this perspective generate me better returns than the market?
So
Now, can I add on this? Guys, how many of you have 10 mutual funds? I mean, people who have not put up the hand, do they have lesser? Huh?
This is a concentrated audience.
So the point is, a manager may generate alpha for you. Okay, but all managers will not generate alpha at the same time. Okay, so if you have too many managers in your portfolio, which is what will happen if you have 10 funds and different looking funds at the same time, after cost you will be below index. So versus that strategy, buy a passive, much better. Much better. So just like a manager says he should have an edge, choose your manager well and don't choose too many of them.
Correct. That's a fair point. But I think his question was more on direct equities, if I'm not wrong.
Yes.
Yeah. And the non-negotiables while choosing a stock. But okay, we don't have time. Time is up. So we'll take one last question. Yes, the gentleman here in the front row.
Hi, this is Gautam. I have a question for Kalpen. So it's following up the question on the debt markets we were talking about. According to me, there is cross-collateralization for RBI rate decisions from the Fed. Okay, so I wanted to understand, obviously, if your interest rates are going down, you're making more mark-to-market on your bonds. Okay, I just want to understand, what do you think about this? and like for rate decisions or hiking decisions? And are you like kind of dovish? Because if the central bank and like the Fed is dovish with Kevin Walsh being, as the chair, kind of, I mean, that's what Trump wants. So I wanted to understand that a little better. And secondly, for retail, how can they get access to good institutional data? Because I've been doing this and I'm not able to find good institutional data. Obviously, institutions have an edge on this. So if you can explain a little bit on that as well, please. Thanks.
Gautam, right?
Yeah.
See, I started my career in 98 on a bond desk. 28 years, आप कुछ भी कर लो, जो भी bond yield होता है ना, उसे आधा टका ऊपर नीचे मिलता है. So the need to do so much of analysis about Fed RBI conversations, anyways, it's outside my pay grade. I don't even know that, whether they talk to each other for rate decisions or not. Even if they were to talk to each other for rate decisions, you and I can't do anything about it. So I always ask this question, that after all of this, करना क्या है और क्या कर सकता हूँ मैं? So all I know is, our view is right now reflected in our portfolio duration. So a fund where we can go flexible on duration, we are somewhere in the middle. We are not at very high duration, because when will we be at very high duration? When we have very clear rates will fall. We are not at very low duration. When will we be at very low duration? When we know rates will rise very sharply. Now rates have already risen by 70, 80 basis point. Our view is that this is an environment of worry, because currency is falling sharply. Any rate cut or slide in rates can have a larger impact on currency. So we are in the middle again, where it's not easy to solve. And personally, I have realized one thing, there is no need for you or me to take binary decisions as retail investors. We don't need to worry about binary decisions, kya hone wala hai.
But then you're not going for alpha, right? If you want...
My alpha is not taking binary decisions. Because when we take binary decisions, it brings in a lot of overconfidence that I know kya hone wala hai. The world is hugely probabilistic and multidimensional. We may think the path is going to be A, B, and C, but the path could be all the other 23 alphabets which are there between A to Z. It's very tough to forecast paths. We don't acknowledge some of these fundamental realities of the world. The world is almost unknowable. We know 1 or 2% of it, on which we have highest amount of conviction with the least amount of homework. So point I'm making is that rates will middle along. We don't see reasons for very sharp rise. We don't see reasons for very sharp fall. So we will maintain moderate duration. I don't know about how can individual investors get institutional data. I can check with my team and come back to you. I don't have an answer to that. But as of today, fixed income does make sense for the last 2 years. Let's say a lot of individual small and mid cap stocks have fallen 30 to 40%. And if you ended up just owning short-term bonds, your 100 would have become 114 in 2 years. So 14 versus 30 negative, there is a 44% alpha. So I'm not going for alpha in your style, but my bond still gave me alpha compared to a lot of individual stocks. And 40% alpha in this period is huge alpha.
I mean, the reason I asked you about that was because equity markets, people generally participate in the equity markets. But what about the bond market? Because
bond
that
funds
derives the equity returns as well.
There are better ways to do that through bond funds or hybrid funds. As of today, many hybrid funds are sitting on 60% cash or bonds and earning 6 to 8% return. When markets go nowhere for 2-3 years and go down 20%, some part of your portfolio is growing at 7-8% within that fund. So today, most of these hybrid funds will start, they are actually gradually increasing their weights towards equities. So if we were 20% in equities, today we are 48% in a matter of last 6 months. Where does that 27% come from? It's come from the bonds. So hybrid funds do that for you in a tax efficient way. A lot of people ignore hybrid funds. But the role of bonds is most valuable. It is like having brakes. You will not run a car with 2 accelerators, even though it will take you faster. That's called growth investing, double growth. You will need a brake, you will need a seat belt. So bonds play that role, and hybrid funds offer that in such periods when there is higher uncertainty.
Okay, well, thank you so much, and a big round of applause to our entire panel here. Unfortunately, our time is up. We would have loved to take some more questions, but thank you to all of you for joining us. And as Kalpen said, forget chasing alpha. Kalpen, what did you say? We don't even deserve alpha. That's how you started, right? So, so remember that line as you go. Okay. But it was a great panel. So thank you to everyone for being here.